Welcome to the Deep Dive, where we sift through the latest data, earnings calls, research, expert notes, the works, to bring you the core insights. Today, we're diving into La-Z-Boy Inc.'s fiscal 2026 first quarter results. This report definitely sent a ripple through the market, and we're here to unpack what it means for this iconic brand and, well, for you.
Yeah, it was really a classic case, wasn't it? Trying to navigate these immediate challenges while, keeping your eyes firmly set on long-term strategic goals.
Right.
We'll break down the numbers, take a look at what management's doing, and explore that tension between, let's call it short-term pain and potential long-term gain.
Okay, let's jump straight into the headlines then. So La-Z-Boy reported adjusted earnings per share of $0.47 for Q1. Now that missed the consensus estimate, which was around $0.53, missed it by about 11%.
Yeah, that's a decent miss.
And it's a pretty significant drop year over year, down 24%. Revenue also came in a bit light, approximately $492 million.
Just shy of the $494 million expected, so down 1% year over year there.
Exactly.
Yeah.
And the adjusted operating margin, that landed at 4.8%, also lower than analysts expected.
And, well, as you might guess, this performance prompted a pretty swift market reaction.
I bet.
And notably negative. After the earnings release, the stock took a sharp drop in after hours. It even hit a 52-week low intraday.
Wow.
Yeah, the immediate feeling clearly reflected investor concern, over both the earnings miss and the revenue miss, plus those wider industry headwinds we keep hearing about in furniture.
Right, the tough consumer environment.
Exactly. The market certainly didn't hold back its opinion.
Okay, so that's the snapshot, and yeah, it's certainly not glowing. But we dig a little deeper, we start to see some, well, interesting, if maybe mixed dynamics across the different segments.
That's right.
Can you walk us through those segment specifics? Because it's not quite a uniform story, is it?
No, absolutely not. It's far from uniform. Let's start with the retail segment.
Okay.
Here we actually saw delivered sales increase by 2% and written sales by 5%.
Okay, that sounds better.
On the surface, yeah, it sounds positive, maybe even encouraging in this market. However, the key detail, the real story here, is that this growth was primarily driven by new and acquired stores.
Oh, okay.
When you strip that out and look at the existing locations, same-store written sales actually declined by 4%.
Right, there it is, that 4% decline.
Yeah. That signals that even with new stores kind of masking the overall growth, they're finding it tough to get more business from their established stores. It's a core challenge.
And management mentioned new stores drag on profit initially.
Exactly. They said typically a drag in year 1, improves in year 2, and hopefully margin accretive by year 3. So it's definitely a long game they're playing with that expansion.
That 4% same-store decline really feels like the number to watch going forward. And it definitely contrasts with wholesale, right?
Yeah.
How did that segment do?
Indeed. The wholesale segment was a bit brighter. It delivered a 1% increase in delivered sales, mostly from growth in its core North American business. But what's really interesting here is that its adjusted operating margin improved. It went up to 7.5% from 6.9% last year.
How'd they manage that?
Well, they attributed it to a few things. Lower warranty expenses, less marketing spend, and some gross margin expansion. Their strong North American manufacturing base probably helps them navigate the current trade and tariff stuff too, giving them a steady product supply and, some cost control.
Yeah, that makes sense. Though you have to wonder how sustainable lower marketing and warranty costs are long term.
That's a very fair question. Are they temporary gains or something more structural? We'll see.
So wholesale offered a glimmer. But then there's the part of the business that's been a consistent worry for investors, and it really stood out this quarter. Joybird.
Ah, yes, the elephant in the room.
What happened there? How bad was it?
You're right to flag Joybird. It faced significant headwinds. Delivered sales were down a pretty staggering 20%.
20%, wow.
Yeah. And written sales down 14% year over year. This underperformance led to a bigger operating loss for Joybird, which definitely dragged down the consolidated results.
Was that online weakness mainly?
Well, they did say physical store performance for Joybird was a bit stronger than online, but overall, yeah, it remains a real point of concern. That direct-to-consumer model for Joybird seems to be struggling in this climate.
Okay, so a real mixed bag on the segments. Obvious struggles. Yet, management kept talking about their Century Vision strategy, painting this much more optimistic long-term picture.
Right.
How are they balancing these immediate problems with those, well, pretty ambitious long-term goals? What are the key parts of this vision?
That is the core tension right now for Lazy Boy. The Century Vision, it's all about strengthening the core, expanding direct-to-consumer, and making the supply chain more agile.
Okay.
Retail expansion is a huge piece of this. They just announced their largest independent gallery acquisition ever, a 15-store network in the Southeast.
15 stores. Wow.
Yeah, expected to add about $40 million in annual sales. That should close late October. Plus, they opened 2 new company stores in Q1, making it 13 new company stores in the last year.
And more planned.
Yep, plans for 15 new galleries total this fiscal year. And even Joybird, despite the sales drop, is adding stores, opened its 14th, with 3 to 4 more planned.
That is seriously aggressive expansion, especially when they're talking about a challenged consumer and sluggish traffic. Isn't that contradictory, or is it just a calculated gamble?
It's definitely a calculated risk. Management's betting long-term on owning more of their retail. They think it gives them better control, better customer experience, and ultimately better profit down the road.
Okay, what else is part of this vision?
Another critical piece is the distribution transformation. They just successfully transitioned to a new Arizona distribution hub. That's the first of 3 planned central hubs.
Okay, centralizing distribution.
Exactly. It's a multi-year project. The goal is to cut their distribution footprint by about 30%, reduce inventory mileage by 20%, double their delivery radius, and this is key, achieve 50 to 75 basis points of wholesale margin improvement long-term.
0.5 to 0.75%? That's significant, but not immediate.
Definitely not immediate. They explicitly said expect a modest drag on adjusted operating margins for the first 2 years because of, transition inefficiencies. Savings should start in year 3, full impact by year 4.
Right. Short-term pain, long-term gain again.
Precisely. It's a major investment in infrastructure.
And beyond the physical stores and warehouses, they're also working on the brand itself, the softer stuff.
Yeah, exactly. Big focus on brand identity and reach. They launched a refreshed brand campaign back on National Lazy Day, introduced a new brand look, trying to stay relevant, top of mind.
Any external validation?
Well, they got recognized by Newsweek as the #1 furniture retailer in America for 2025. And they added Farmers Furniture, that's a 250-store retailer in the Southeast, as a strategic partner to help reach more rural markets. So yeah, moves to solidify their position and broaden access.
Okay, so lots of moving parts strategically. New stores, distribution overhaul, brand work. Let's pull back. How's their overall financial health to actually do all this? Can they afford this Century Vision without straining things?
Actually, from a liquidity perspective, they're in a really strong position. They ended the quarter with $319 million in cash. And critically, no external debt.
No debt. Okay. So that's huge.
It is. They also generated $36 million in operating cash flow. This fortress balance sheet, as they sometimes call it, is what lets them play offense right now.
But they are shifting how they use that cash.
Yes, their capital allocation for fiscal 26 is changing. They returned about $22 million to shareholders in Q1, mostly buybacks, some dividends. But they said expect minimal share repurchases for the rest of the year.
So 11 buybacks.
Much less. The focus is now heavily weighted towards investing back in the business. New stores, remodels, acquisitions, that distribution project. Total CapEx expected around $90 to $100 million for the full year.
That makes sense. Prioritizing the build-out.
Clearly signals their priorities right now. Internal growth over immediate buyback returns.
Okay, and what about their guidance for next quarter? Given this challenged consumer, are they seeing things turn around quickly? Or is it still tough sledding ahead?
Management was pretty clear about acknowledging the challenged consumer. They pointed to weak housing transactions near 30-year lows and that sluggish traffic.
Yeah, tough backdrop.
Definitely. It sounds like they're balancing that long-term optimism with some very pragmatic cost control. They even mentioned evaluating alternatives for non-core parts of the business, like case goods and international ops, to ease financial pressure.
Shedding non-core assets potentially.
Potentially looking at options, yes. They also did some strategic promotions in Q1, especially on case goods, probably to clear inventory before the holidays.
So what are the numbers for Q2?
For Q2 2026, they expect revenue between $510 million and $530 million, and an adjusted operating margin between 4.5% and 6%.
Okay, so maybe slight sequential improvement possible at the high end, but still fairly tight margins.
Right. They did mention seeing some sequential improvement in traffic and written sales in early August, but they were quick to caution. It's way too early to call that a trend. So, cautious optimism, but definitely acknowledging the headwinds remain.
This really highlights the key tension for investors, doesn't it? You've got these challenging Q1 numbers, the negative market reaction.
Yeah, undeniably rough short-term signals.
But then management is painting this very different, much longer-term picture with a century vision. It creates this fascinating split.
It absolutely does. That sharp stock drop really underscores the market's low confidence in any near-term turnaround. Investors are reacting to the misses, the Joybird drag, the whole consumer discretionary softness. So even though management's talking up the fortress balance sheet and playing offense with these big investments, the market seems to be saying, show me the results first. It's pricing in continued short-term pain.
So the question for you listening in becomes, how much long-term value are these short-term pressures actually masking right now?
Exactly. Will the distribution transformation and the retail expansion pay off? They could be critical catalysts, but the benefits aren't immediate. And the market, well, it often struggles with delayed gratification, doesn't it?
All right, speaking of market bets, it's time for our This Is Not Financial Advice segment. You know the drill. We pitch an outrageous but plausible trade idea purely for entertainment and discussion.
Okay, given La-Z-Boy's Q1, the market reaction, here's a thought. Maybe consider a long-term position, accumulating shares now while they're down. Basically betting on that Century Vision strategy to eventually drive some really solid gains maybe in a few years.
So buying at the 52-week low.
Potentially, yeah. That could be a compelling entry point if you have patience. The outrageous part is obviously going against this immediate bearish feeling, the weak consumer story.
Okay, so that's the outrageous part. What makes it plausible?
The plausible side rests on that strong balance sheet, no external debt, remember. Plus, the clear roadmap for that margin improvement from the distribution overhaul, 50 to 75 basis points by fiscal 29, and the sheer scale of the retail expansion.
So it's a bet on execution and recovery.
Exactly. This isn't a quick flip. It's a bet on strategic execution clicking, and eventually a cyclical recovery in housing and consumer confidence. You're anticipating the market will eventually recognize the value they're building, even if it takes time.
Okay, interesting thought experiment there. So to recap our deep dive, La-Z-Boy's Q1, definitely a mixed picture. An earnings miss, real weakness in Joybird, that worrying same-store sales decline.
Yeah, the challenging parts were clear.
But on the other side, significant progress on these big long-term strategic moves. Retail expansion, supply chain transformation, brand focus, all backed by that solid balance sheet.
It's that classic story, right? Short-term pain for potentially long-term gain playing out right now. Management's clearly playing the long game, using their financial strength to invest, even when the current environment is tough.
So for you, the listener, the question really becomes, what specific signs will you watch for in the next few quarters? What confirms that this Century Vision is actually taking hold?
Is it seeing those same store sales turn positive again?
Or seeing the profitability ramp up from all those new stores they're adding?
Or maybe the first real hints of efficiency savings from those new distribution hubs starting to show up in the margins?
Those seem like the key indicators, yeah.
Yeah.
The proof points of whether their strategic patience is going to pay off.
Mm-hmm.
What, for you, is maybe the single most important metric they need to nail to show this vision is becoming reality?
That's a great question to ponder. Thank you for joining us for this deep dive into La-Z-Boy's latest earnings.
We hope this analysis helps you make sense of the market's twists and turns. Join us next time on The Deep Dive for more insights.